Today we're going to be talking about how the Federal Reserve controls money supply by using monetary policy.
So, you're probably wondering how the Federal Reserve helps the economy.
In 2008, the U.S. experienced a major financial crisis that led to the biggest recession since the Second World War. Both this financial crisis and a downturn in the U.S. economy spread to many foreign nations, leading to a global economic crisis.
In response to the crisis, the Federal Reserve adjusted monetary policy and came in to save the economy. Next up on Saturday Night Live, our experts will talk about how monetary policy affects the money supply.
The Federal Reserve is a government-run organization that regulates money supply using three modes of monetary policy: a discount rate, reserve requirement, and open market operation. The discount rate is the rate at which banks can borrow money from the Federal Reserve. The reserve requirement establishes the minimum amount of money that banks must keep as required reserve. Open market operation involves the purchase or sale of government debt, aka bonds, by the federal government, in forms of U.S. Treasury bonds.
Danielle, how does the Federal Reserve decrease the money supply?
Well, speaking, contractionary policy is used during an inflationary gap. When it is used, money supplies decrease, which directly decreases aggregate demand. Three ways this is done is by selling bonds, increasing the discount rate, and increasing the reserve ratio. These accomplish the goal of the contractionary policy because a decrease in money supply relates to less spending. The Fed would do this to stabilize the economy.
So Melissa, how does the Federal Reserve increase money supply?
Well, when the country experiences a recessionary gap, the Fed adjusts monetary policy to increase money supply. Doing so will stimulate spending and help the economy out of a recession. The Fed could either utilize open market operations to buy bonds, decrease the discount rate, or decrease the reserve ratio. These policies give banks more money to loan, thus increasing the money supply and shifting aggregate demand to the right.
When monetary policy is used, the two graphs of money supply and aggregate demand are portrayed as a cause and effect relationship. As money supply is increased, real GDP and price level increase, thus increasing aggregate demand. And you can see here as this increases, I'm going to draw a little line. Aggregate demand also increases. And there's some procurement.
According to this really official book, the Fed regulates the economy, monitors and adjusts supply, fixes inflation, and wait! I just flipped this book the right way? It even protects consumers.
According to this book, adjusting monetary policy through government regulation is important because price levels could fluctuate uncontrollably. Both are vital because the price of the dollar determines what people can buy, whether you're in the US, Porkopolis, or Zimbabwe. Next, we have a short cartoon clip that exemplifies what the Federal Reserve does and highlights the history behind it.
When you're building something important, you need a good structure. What will make it last? How's it supposed to function? And what will make it strong? That's what the U.S. Congress was thinking about when they decided to build the Federal Reserve System. They needed to build something that would strengthen America's economy and its banking system so America could thrive. In 1907, the nation went through a severe financial panic. So the U.S. President and Congress decided they needed a system that would help the economy run smoothly. A small group of nationally known politicians and financiers gathered at Jekyll Island off the coast of Georgia. Here, they constructed the outline that became the Aldrich Plan for development of the Federal Reserve System. This meeting was held in 1910, and the charter for the Federal Reserve was signed by President Woodrow Wilson in 1913. The plan envisioned a central bank that has government oversight, yet works independently. This means it's a central bank that can help keep the economy healthy without pressure from short-term political interests. But the Fed alone doesn't have all the tools to keep the economy growing at a steady pace. The job is not one for a single organization. And there's a difference between monetary policy, the Fed's province, which influences the economy by changing the supply and demand of money, and fiscal policy, the province of Congress, which uses tax and spending changes to affect the economy. So what does this mean to you? Well, the Fed is important because it keeps America's monetary system stable and growing with low inflation. And that allows people and businesses to make better buying and spending decisions, which fosters further growth, which helps keep the economy going in the right direction. But if the economy isn't healthy and money is tight, people may be afraid to spend, and the economy won't grow. That's hard on everybody.
Next on SNL, we have Pearl from Porkopolis. So Pearl, what would happen without the Federal Reserve?
Well, let's take a look at the short video.
What if central banks did not exist for the past century? Imagine a world without the power of the Federal Reserve. Without the Federal Reserve, the country would be in economic turmoil. The value of the dollar would be unstable, which would cause unemployment and consumer spending to be erratic. In addition, the Fed serves as our central government banking system. If smaller banks were responsible for adjusting money supply, it's possible they may make decisions based on competitive business motives. In retrospect, the Federal Reserve has stabilized our economy since its establishment. Without it, our banking system would be disorganized, unsafe, and unstable. They decide monetary policy.
So before we go, what is that, Pearl? Oh, it's time for a history lesson with Professor Devin.
Professor Devin Besoya will elaborate on the Fed's involvement during 9/11 and how it reduced economic crisis.
In the days following 9/11, how did monetary policy and the Federal Reserve help save the U.S. economy?
Well, after 9/11, the Federal Reserve lowered interest rates and lent more than $45 billion to financial institutions, and they also lowered the discount rate.
Good night, Porco!